Are you new to flood insurance? Do you need a refresher? If so, this presentation is designed to introduce the basics of flood insurance. This presentation will be divided into 5 basic sections. The first section will include an introduction to flood insurance, which will focus on the availability of the flood product and the definition of a flood. We will then continue with policy information, including flood insurance coverages. The next section focuses on structural and rating details, and finally we conclude with hints and information concerning endorsements, cancellations, reporting of flood loss, and E&O concerns. A very common question when first starting to talk about flood insurance is who needs flood insurance? All owners of insurable property should consider flood insurance. Insurable property includes a building and/or its contents in a community that participates in the National Flood Insurance Program. Flood insurance is available for owners and renters, buildings in the course of construction, condominium associations, as well as residential condominium units. Everyone is in a flood zone. It's just a matter of if the structure is located in a low-risk flood zone or a high-risk flood zone. The definition of a flood is an integral part of the flood program and is clearly stated in the National Flood Insurance Program's Flood Insurance Manual. In order to meet the definition of a flood, there are a few terms that are essential. The first is 2 or more acres of normally dry land. To be considered a flood, the land has to be dry normally and is now inundated with rising water. This rising water should encompass either 2 or more properties or 2 or more acres. I grew up in a farm and my house sat on 1 acre of land. If the acre that my structure sat on flooded and another acre flooded, that would meet the definition of a flood. I currently live in a condo. If my condo, which I own, floods, and the water runs out into the street in front of my condo, I don't own the street in front of my condo, that meets the definition of a flood. These structures also do not have to be adjoining. As long as the flooding is from the same event, and as long as it covers either 2 or more acres or 2 or more properties, that would meet the definition of a flood. Another important phrase in the definition is that the waters can come from any source. It doesn't have to be a hurricane or a tropical storm. The storm drain outside my condo could freeze. When the water rises, it could flood. And as long as my structure and another property would be flooded, that meets the definition of a flood. The definition of a flood also makes the distinction between mud flow versus landslide. A mud flow has more water mixed with soil and has the consistency of a chocolate shake. Mud flow is covered in the definition of a flood. A landslide has more soil than it does water, or the consistency of a piece of crumpled chocolate cake. The chocolate shake is covered, not the chocolate cake. So mud flow will meet the definition of a flood, but landslide will not. The definition also does not cover sinkholes or any areas that flood to a specific level every year. Flood insurance can be written in communities that sign up to participate in floodplain management and that are approved as active participating communities in the National Flood Insurance Program. The NFIP contains 2 levels of community participation. The first is the emergency program. When a community applies to participate in the National Flood Insurance Program, the NFIP allows that community to participate on just a temporary basis in what's called the emergency program. The NFIP gives the community a list of items that have to be completed, before that community can move into the regular program. Once the list of items has been completed and the detailed flood map has been ratified, the community is then approved and is allowed to participate in the regular program. Theoretically, a community will stay in the initial phase or the emergency program for 6 months. While in the emergency program, a community can offer very limited coverage. The maximum building coverage available for a single-family dwelling is $35,000. Contents coverage is $10,000. The maximum amount of coverage available in the flood program under the emergency program for a commercial structure is $100,000 in building coverage, $100,000 in contents coverage. Once a community has completed the application process and is fully approved, that community then moves into the regular program and can offer the maximum amount of coverage that's available, which is $250,000 in building coverage for a single-family dwelling with $100,000 in contents coverage. Other residential structures as well as commercial structures can purchase $500,000 in building coverage and $500,000 in contents coverage. It's important to know that the flood program will never pay higher than those amounts. These are the maximums available in the National Flood Insurance Program. Now that you have an introduction to the flood program, our next section we're going to cover is some policy information. The flood insurance policy is a single peril policy that only covers direct physical loss by or from a flood. Flood insurance will not cover additional living expenses, nor will it cover loss of use or loss of income. It will cover structures and possibly the contents inside of that structure, but it will not cover the land that the structure sits on. The flood insurance policy is not designed to make the insured whole after a flood loss. The flood program has one policy called the Standard Flood Insurance Policy with 3 forms. The first is the dwelling form. The dwelling form is issued to insure a non-condominium residential building designed for principal use as a dwelling place and for 1 to 4 families or a single family dwelling. The dwelling form is an actual cash value policy with a built-in replacement cost provision. At the time of a flood loss, in order to be paid replacement cost, 3 qualifications must be met. First, the structure has to be a single-family dwelling. Second, the structure has to be the primary residence, which means that the insured lives in that residence for 80% of the policy term. The third qualification is that the structure has to be insured up to 80% of the replacement cost at the time of loss or the maximum coverage available in the flood program. If all 3 of these qualifications are met, the loss is then paid replacement cost for the building coverage. If all 3 qualifications are not met, then the loss is settled actual cash value. The second policy form is called the General Property Form. The General Property Form is for structures such as commercial properties. Other examples would be assisted living facilities, hotels, or even a restaurant. In the event of a loss, the General Property Form will be paid out actual cash value. Replacement cost is not available in the event of a flood loss for the General Property Form. The third policy form under the Standard Flood Insurance Policies is called the Residential Condominium Building Association Policy, or the RCBAP. This is the Condominium Association's master policy. This policy has replacement cost coverage with a coinsurance penalty. In the event of a flood loss, the RCBAP will be paid replacement cost on the building coverage. However, if the structure is not insured to 80% of the replacement cost or the maximum allowable in the flood program, a coinsurance penalty will be applied before the claim is paid. Contents coverage, no matter which of the different policy forms is being used, is always settled in actual cash value. The National Flood Insurance Program does have a couple of additional products that are available. The first product is the Preferred Risk Policy. This policy is written either under the dwelling form or the general property form. The Preferred Risk Policy is a low-cost package policy that offers reduced premium for the low-risk flood zones, which are called non-special flood hazard areas, or zones beginning with the letter B, C, X, A99, and AR. This product offers packages with a combined building and contents amount, or even contents only. Loss history criteria must also be met before the policy can be issued. Ultimately, there can be no more than 2 losses, each more than $1,000. For more detail on the loss history criteria, please refer to the Flood Insurance Manual. Newly mapped policies follow very specific procedures that are also outlined by the National Flood Insurance Program. These procedures allow the insured to gradually transition into higher premiums until the policy is either written using an elevation certificate or the risk is grandfathered. One common misconception when dealing with flood insurance is that areas are not in a flood zone or they're not in danger of flooding. Statistics show that 25 to 30% of all flood insurance claims made on the National Flood Insurance Program's flood policy originate from low to moderate risk flood zones. These are the areas where a preferred risk policy may be available. Now that we have a basic knowledge of policy information, let's turn our thoughts to structures and how those structures are rated. The term FIRM stands for the Flood Insurance Rate Map. The FIRM is an official map for a community where FEMA places every single property in a flood zone. And it is also the last task that has to be completed in order for a community to move into the regular program. Pre-FIRM describes a structure that was built or was substantially improved before the Flood Insurance Rate Map or the FIRM was established. Structures built before December 31st of 1974 are also always considered pre-FIRM. Pre-FIRM properties have rates specifically designed for structures that were built before the floodplain regulations were in place or prior to the FIRM. Pre-FIRM structures have rates for special flood hazard areas as well as rates for non-special flood hazard areas. Post-FIRM then describes a structure that was built or substantially improved after the Flood Insurance Rate Map was established. So these structures were built after the floodplain regulations were in place. Post-FIRM structures have to follow these building codes in order to be considered built in compliance. Why are the terms pre-FIRM and post-FIRM so important in the National Flood Insurance Program? Ultimately, pre-FIRM and post-FIRM are terms that are used when determining how compliant a structure is with the building codes that were established by the National Flood Insurance Program. Structures that were built after the initial flood insurance rate map was established should be built according to the community building codes as well as floodplain management guidelines. Because post-FIRM structures must meet these regulations, the underwriting guidelines are more stringent and rates for these structures reflect how compliant the structure is. Pre-FIRM structures were built before the building codes were in place, and the rates do reflect that. Let's focus for a moment on the elevation certificate. When are elevation certificates required? An elevation certificate is required for properties that are post-firm construction and are located in the special flood hazard areas. Again, zones beginning with the letter A or V. Elevation certificates are optional for structures that are pre-firm construction, also in the special flood hazard areas. If the elevation certificate leads to beneficial rates, then the elevation certificate may be applied. However, if the elevation certificate does not result in more favorable rates, the elevation certificate will not be required. Structures located in the non-special flood hazard areas, which are zones beginning with the letter B, C, and X, the elevation certificate is not required and it's not a consideration for rating. Where do I find an elevation certificate? Elevation certificates do not always have to be brand new. Older copies that have already been completed are acceptable. The policyholder can start by contacting their local community officials. Communities do keep copies of elevation certificates on files in certain areas. The seller or developer may also have a copy. If that structure was post-firm in a special flood hazard area, elevation information may have been a requirement at the time of the construction loan or the buyer loan. The insured may have to hire a licensed surveyor, a licensed engineer, or a licensed architect to complete the elevation certificate, the cost of which will vary from community to community. Another place to look is to check with your community officials. Some community officials do allow an elevation certificate to be filed with the property deed. Finally, why are elevation certificates required? An elevation certificate is a tool used to determine if a structure was constructed in compliance with the floodplain management guidelines. The payoff for building in compliance is that the higher the lowest floor is above the flood risk, the lower the rates for flood insurance will be on that structure. If a policy is rated applying the elevation certificate, it is said to be a full risk rate. Finally, I want to share with you just a few other facts and general rules. The flood policy is a one-year policy only. No multiple-year policies are available in the flood program. The flood policy will renew without a lapse in coverage as long as a renewal premium is received no later than 30 days from the expiration date. If the premium is received in the 31st to the 90th day and is not being required by a lender, a 30-day waiting period will be applied. Any premium received after 90 days and coverage is not being required by a lender or a new policy will have to be written. The flood program also does not accept a payment plan. Full premium must be included with any applications, endorsements, or renewals. The flood policy will renew without a lapse in coverage as long as a renewal premium is received no later than 30 days from the expiration date. If premium is received in the 31st to the 90th day and is not being required by a lender, a 30-day waiting period will be applied. Any premium received after 90 days and the coverage is not being required by a lender, a new policy will need to be written. The flood program also does not accept a payment plan. Full premium must be included with any applications, endorsements, or renewals. Flood policies have two deductibles, one for building coverage and one for contents coverage. The deductible do apply separately. Deductibles will vary based on policy rating and the amount of flood coverage that's being purchased. The National Flood Insurance Program has a variety of deductible options that are available. However, when choosing a higher deductible, there are a few considerations. Deductibles may be increased any time during the policy term. However, a reduction in the deductible midterm can only be done if it's required by a mortgagee, and in that instance, the mortgagee must provide written authorization. Once written authorization is supplied, a 30-day waiting period will be applied unless the change is being done in conjunction with a loan closing. The National Flood Insurance Program also has a standard 30-day waiting period with only two exceptions. The first is if coverage is being purchased for a loan closing. No wait applies for a loan closing as long as a premium is being funded by the lender, mortgagee, title attorney, title company, escrow, etc. And the requirement for flood insurance is made in order for a loan closing to take place. The second exception occurs for a MAP provision. In that instance, a one-day waiting period will apply. The one-day wait is available on new policies within the 13-month period from a MAP provision. If the policy is being voluntarily purchased, or if the loan closing has already taken place, then a requirement for flood insurance is made, a 30-day waiting period will be applied. The 30-day wait will start the date the application as long as a presentment of premium occurs within 10 days from the date of application. If the premium is received after 10 days from the date of application, the 30-day waiting period will begin with the date that the premium was received. A flood policy can be canceled at any time. However, a full refund will not always apply. The National Flood Insurance Program recognizes a specific number of cancellation reasons that they consider valid reasons for cancellation. If eligible, refunds will be pro rata or full refunds depending on the reason for cancellation. To learn more about the valid reasons for cancellation, please refer to the National Flood Insurance Program's Flood Insurance Manual. Claims can be very stressful for both the policyholder as well as the agent. A few simple hints will help the process run smoother. Losses can be reported via phone, fax, email, or online. The insured name, policy number, and date of loss will need to be given. Contact numbers should also be collected. Any phone number, including any landlines, can be helpful. The insured should start the cleanup process by separating any damaged property from undamaged property. The insured should also protect the undamaged property from any further loss and start to document by taking photographs. If possible, the policyholder should locate any receipts on the big ticket items and list any areas of possible structural damage. In conclusion, I'd like to leave you with a few E&O suggestions. Be sure to offer flood coverage with every homeowner's policy. And if the policyholder chooses not to take the flood coverage, document their rejection. Agents do not have binding authority and are not allowed to bind a flood policy. Advise the insured of the 30-day waiting period for new business or endorsements, and be sure to advise the policyholder that replacement cost is not always an option. To access additional information on the National Flood Insurance Program, take a look at the ebook library found at www.nationalfloodservices.com. If you're looking for marketing information, spend some time on www.agents.floodsmart.gov. Thank you for taking the time to learn more information about the flood program. We hope to see you soon on other presentations.